So, Kevin, I know you're looking at earnings season, something a lot of people have talked about, the fact that the EPS outlook for Q3, it drops off pretty significantly from the previous quarter. It was double digits in Q2. This quarter, it's about 4% with about 4% revenue growth. You're saying that's something that investors should look at and possibly be concerned about. Why is that?
Well, because you're coming into this with the multiple on stocks at a something like 20% premium over their 10-year average. If you look at the forward-looking operating earnings for the S&P 500 divided by the price, the multiple is something like 22 times. And if you look back over the last 10 years at that same number, you would get a number like 18. So the market is anticipating growth, but as you've pointed out, the growth rate is rolling over here. And to continue to grow at only 3 or 4%, it might call into question whether or not the market deserves that premium.
All right, so a question about valuation. You're not the first person to bring that up. However, just to mention, some of our other guests said this might be an opportunity because it sets a pretty low bar and the stocks can beat and maybe keep the rally going. Something else that's moving higher right now I want to talk to you about is the dollar. So you're noting the moves on the dollar, but you're also bullish on emerging markets. I just looked up some emerging market ETFs. I'm not saying these are picks from you or anything else, but when I look at these emerging market ETFs since the Fed rate cut, they're actually slightly outperforming some of the cyclical sectors. At the same time, the dollar has moved higher. Isn't that a headwind for those emerging market stocks to see the stronger dollar in recent weeks?
Yeah. So what you've seen is that possibly in response to what China has done in terms of their steps to ease, what you've seen is emerging markets begin to pick up. So they've just demonstrated a little bit of relative performance improvement over what they've been doing in the last few quarters. We just want to move along with that. And secondly, when you look at the dollar more broadly, consider that gold is up 40% or something like that year over year. There is some sense that the pivot from the Fed from very tight money to perhaps easier money might be something that provides, it might take a little bit of the pressure off the upward move in the dollar. So those are the kind of things that are likely affecting the change in the relative performance of EEM. And we just want to move along with that. We don't want to fight that.
Okay. So not concerned about this upside move for the dollar, despite the fact that we're supposedly going into a rate cutting cycle that generally actually softens the dollar. Not concerned about, I think for October, it's up over 2.5%. If it continues to move higher, does that change your thesis on those emerging markets?
It could pose a headwind. That would be one of the risk scenarios, but it's too early at this point to say that we've entered a new bull phase for the dollar. The fundamentals just simply don't support that. So we're sticking with our call that emerging markets are likely going to be providing some leadership here after a long period of underperformance.
All right. Another area that I know you're looking at is fixed income, specifically mortgage-backed securities. I pulled, again, 2 ETFs. I'm not saying that your picks. 2 of the pretty popular ones, the SPMB, also the MBB, 2 very popular ETFs in this space. Dividend yield right around 3.5%. I do want to ask you, why mortgage-backed securities right now as opposed to just regular treasuries or corporate bonds? I'm looking at the yields here. It's about 3.5%. What are you seeing there that makes that more attractive to you than treasuries or corporate bonds? I mean, what are you seeing?
Well, I'd say mortgages just represent a significant portion of the U.S. bond market. I wouldn't say that we're overly enthusiastic about mortgages here. They typically would be an instrument that would play out the best if you have very stable interest rates and investors can pick up carry. I think that ultimately, tactically, the more interesting thing above mortgages would be a point at which you can enter the longer end of the Treasury curve. We've seen Treasury yields backing up, and now we're moving up to about 4.4%. There have been calls for perhaps some higher rates here as we move into the need for the Treasury to fund itself while the Fed is still not buying treasuries. So ultimately, extending duration might actually make a little bit more sense as we move along here. And if the economy continues to, or if the economy begins to show some signs of deceleration from what has been a pretty robust economy.
Okay. So I just wanted to clarify, you are overweight, according to your most recent notes, on mortgage-backed securities, also on the 20-year. So when you say longer term, that's what you're talking about, the 20-year right now.
Yes. We're going to be looking at mortgages as they relate to this. They're a large chunk of the U.S. bond market, so obviously we have to have an exposure there, and there's the sense of some stability in interest rates would be good for that. But the more interesting tactical call for us has been the extension of our duration, and now picking up being overweight duration in the longer end of the Treasury curve.